All right, welcome in everyone, learners. Ready for another deep dive?
Always ready to explore.
Perfect. Today, we're tackling the world of investment, and we've got an incredible source to guide us. We're looking at OR. That's the simplest thing in investing, by Q Guolu.
Now, for those not familiar, Q Gwaler is a bit of a legend. He's the chairman and CEO of Guoyi Assets, and he's got over 2 decades of experience in the markets. Talk about a veteran.
Yeah, and this book, it's not just any book. It's got a foreword by Zhang Lei, the founder of Hill House Capital. That's a pretty big endorsement, wouldn't you say?
Definitely add some weight.
So for the learner, we want to extract those gold nuggets, those fundamental principles that can help you make sense of investing, cut through the noise. Because the markets can be a pretty wild ride.
Oh, absolutely. And this book really focuses on those enduring principles rather than just chasing the latest fads or trends. Things that have stood the test of time. Timeless wisdom.
Right, timeless wisdom. So let's jump right in. The first principle that Ki Guolu really emphasizes is this idea of investing with an industrial mindset. Now, what does that even mean for someone who's maybe just starting to explore the world of stocks and investing?
Well, it's all about shifting your perspective. Instead of just looking at those little ticker symbols going up and down on a screen, imagine yourself as a business owner.
Okay, so putting on a different hat, thinking long-term, not just about quick trades.
Precisely. You're looking at the actual business behind the stock, evaluating its intrinsic value, its long-term potential, and trying to ignore those short-term market fluctuations. The market can be very emotional.
Oh, tell me about it. Full of ups and downs, driven by fear and greed. But Ki Guolu is saying those swings, those emotions, they don't necessarily reflect a change in the company itself, right?
Exactly. He gives a great analogy. He says, just like a factory doesn't suddenly become more efficient just because its stock price went up, a fundamentally sound company stays a fundamentally sound company, regardless of the market's daily mood swings.
That's a really helpful image. So when we're putting on this industrial mindset hat, what are the key things we should be looking at when evaluating a business? What really stands out to Ki Guolu?
He highlights a couple of really important concepts. First, there's the concept of ihero, which translates to moat.
Ah, the moat. Everyone loves a good moat. It's all about protection.
Right. It's that sustainable competitive advantage that a company has that protects its profits, its market share, from those pesky competitors.
Keeps the barbarians at bay.
Exactly. And Q Guolu makes a really important distinction here. He says a true moat isn't something you have to constantly rebuild. It's got to be more inherent to the business, more lasting.
Otherwise, you're just spending all your resources on defense. So what happens in industries where there isn't really a strong moat?
Well, you often see this pattern where one company rises to the top, but then they quickly fade away.
Another one bites the dust, and a new it company takes its place.
Exactly. And that brings us to the second key concept, E, which means threshold or barrier to entry.
Ah, making it hard for the new kids on the block to muscle in.
Right. Q Guolu loves industries with high barriers to entry. Think about it. If it's really difficult and expensive for new companies to enter the market, the established players have a much easier time maintaining their profits.
They can just relax a bit, enjoy the fruits of their labor, less competition, more stability.
Exactly. But contrast that with industries where there are really low barriers to entry. Everyone can jump in, which leads to cutthroat competition, and often no one really makes a sustained profit.
It's a race to the bottom, squeezing those margins.
Yeah.
Now, does Q Guolu give any concrete examples of these concepts playing out in the real world?
He does. He talks about the white goods industry in China, specifically home appliances. Now, in the early 2000s, this industry was booming. Everyone wanted refrigerators, washing machines, air conditioners, you name it.
China was on the rise, the economy was growing, and consumer demand was through the roof.
Right. So from 2000 to 2005, the industry was growing at an incredible pace. But here's the thing. All that growth didn't translate into big profits for the companies.
Why not? You'd think with all that demand, they'd be rolling in dough.
Well, there was just so much competition, so many manufacturers vying for a piece of the pie. Intense price wars kept the profit margins razor thin.
Ah, so they were selling a lot, but not making much on each sale.
Exactly. But then, around 2005, things started to change. There was a shakeout in the industry. A lot of those smaller, less efficient companies couldn't keep up. they went bankrupt.
Survival of the fittest, only the strong remained.
And as a result, the remaining players, companies like Gree, Medea, and Hare, found themselves in a much stronger position. They had greater scale, better distribution networks, lower costs, and established brands.
So those barriers to entry, those moats, started to widen.
Exactly. And what happened? From 2006 to 2010, even though the industry growth had actually slowed down, their profitability shot up and their stock prices soared. Some even saw their stock prices increase tenfold.
Wow, that's incredible. So even with slower growth, the companies with the strong moats operating in an industry where it was harder for new players to enter actually thrived. And that's a really powerful lesson for the learner. It's not just about chasing the fastest growing industries. It's about understanding the underlying dynamics of competition and the long-term advantages that a company possesses.
Exactly. It's about seeing beyond those flashy headlines and digging deeper into the fundamentals.
Love it. Okay, let's move on to the second core principle from Q Golu. He's a big advocate of something called contrary investing, or ANDROP. Now, that sounds a bit counterintuitive, doesn't it? Going against the crowd.
Well, it's all about challenging conventional wisdom, thinking differently from the herd, buying when others are selling and being cautious when everyone else is euphoric.
It's like that classic Warren Buffett quote, "Be fearful when others are greedy and greedy when others are fearful."
Exactly. And Q Golu isn't alone in this belief. He quotes a whole bunch of investing legends who share this contrarian philosophy. People like George Soros, John Templeton, Charlie Munger, Carl Icahn.
A real Hall of Fame of investing.
Right. They all, in different ways, stress the importance of independent thinking and recognizing that the crowd can often be wrong.
So you're not just blindly going against the flow, though, right? There's got to be some method to this contrarian madness. What does Q Golu say are the essential things to consider when practicing this approach?
He outlines 3 really crucial points. The first one, and it's always at the forefront of value investing, is valuation.
Make sure you're getting a good deal, not just buying something because it's dropped in price.
Right. So when a stock has taken a hit and the price has gone down, you've got to ask yourself, has it become genuinely cheap relative to its actual worth? Or has the market just overreacted? He warns against what he calls catching a falling knife. Just buying something because it's going down without really analyzing the situation.
Ouch. Sounds painful.
It can be. He gives the example of the A-share computer industry back in 2011, 2012. Some of those stocks had been really popular, but then they started to decline. And some people jumped in thinking they were getting a bargain. But those valuations, those expectations for future profits, they just kept getting downgraded.
So those stocks kept falling, and those bargain hunters got burned.
Exactly. So it's not just about seeing a low price. It's about understanding whether that low price actually represents an undervaluation based on the fundamentals of the business.
Got it. Due diligence is key. What's the second crucial consideration for contrarian investors?
It's about understanding the nature of the problem or the negative news that's causing the stock to decline. You have to ask yourself, are these temporary issues that are likely to be resolved, or are we looking at deeper, more structural
A
problems?
short-term blip or a long-term trend? That's a critical distinction.
He gives the example of traditional retail. Brick and mortar stores have been struggling for years now, right? That's a more structural, long-term challenge. But then you might have a leading consumer brand that has a food safety scare.
Uh-oh, not good for business.
Right. But that might be a more temporary setback. Consumers might initially lose confidence, but if the brand addresses the issue effectively, they might regain that trust.
So a temporary dip in the stock price could represent a buying opportunity for a patient investor.
Exactly. It's about distinguishing between those short-term hiccups and those more permanent shifts in the industry landscape.
You'll want to get caught in a value trap, as they say.
Yeah.
Now, what's the third element of successful contrary investing?
This one's a little more nuanced, but equally important. It's the idea of reflexivity. Will the very fact that the price is going down actually make the company's situation worse?
So a sort of self-fulfilling prophecy. The price drops, and that, in turn, causes further damage to the business.
Exactly. He uses the examples of Bear Stearns and Lehman Brothers during the financial crisis. Their stock prices started to fall, and that triggered downgrades in their credit ratings. Their lenders got nervous and demanded more collateral.
Suddenly, they were in a really tight spot.
Right. It became this vicious cycle where the falling price itself made their financial situation even worse, and that, of course, led to their collapse. He contrasts that with Chinese banks. Now, they might have issues, but they have this implicit guarantee from the government.
The government's got their back.
So investors aren't as worried that a falling stock price will lead to their demise. They have that extra layer of protection.
That's fascinating. The psychology of the market playing a real role in a company's fate. Now, can you give us some more concrete examples of how this contrarian approach, applied with these considerations in mind, might actually work in practice?
Absolutely. He talks about the example of car stocks in Guangzhou after they announced those purchase restrictions back in 2012. This was a big deal. It created a lot of panic in the market. People thought, oh no, car sales are going to plummet.
Makes sense. Restrictions usually mean less buying.
Right. So car stocks in Guangzhou, they took a huge hit. But here's the thing. Even though the overall market continued to decline in the following months, those Guangzhou car stocks actually rebounded strongly.
Wow, so the market overreacted.
Seems like it. The underlying demand for cars didn't just disappear overnight. The market just panicked. And that created an opportunity for those who are willing to go against the herd.
Buy low, sell high, as they say. Now, what about another example?
He also talks about food safety incidents. Now, those are never good news for an industry, right?
It definitely damages the reputation, makes consumers wary.
Right. But he points out that these incidents can sometimes create buying opportunities in the leading companies within that sector, the ones that are either not involved in the scandal or are less affected by it.
So a bit like a flight to safety. Consumers flock to the brands they trust the most when they're uncertain.
Exactly. He gives the example of McDonald's during the mad cow disease scare, or Taiwan's Unipresident after the plasticizer incident. These were big deals, but they didn't destroy those companies.
They weathered the storm.
And in some cases, they even emerged stronger because they were seen as the safe haven in a sea of uncertainty.
That's really interesting. So when everyone else is running for the hills, the contrarian investor is looking for those hidden gems, those companies that might be unfairly punished by the market's overreaction.
Exactly. It's about separating the noise from the signal and recognizing that sometimes what seems like a disaster can actually create an opportunity.
Love it. Always looking for that silver lining. Now let's move on to the third principle that Ki Guolu highlights. He's got this great saying, "Holta pokol," which basically means cheap doesn't equal bad.
Now, that seems to go against a lot of common wisdom out there, right? Aren't we always told to be wary of those cheap, low-priced stocks? Well, he's not saying to throw caution to the wind and just buy anything with a low price tag, but he is challenging that automatic assumption that just because something is cheap, it must be bad.
Don't judge a stock by its price alone. Look under the hood.
Exactly. He points out that stocks with low valuations can actually represent great investment opportunities. And he emphasizes that the market can be very emotional, very short-sighted.
Driven by those headlines, those quarterly earnings reports.
Right. And he observes that the market often swings between these extremes of optimism and pessimism. After a big rally, everyone gets super bullish, and they start inventing all these reasons why the market's going to keep going up forever.
Irrational exuberance, as they say.
Exactly. And then after a decline, everyone gets super bearish, and they come up with all these reasons why the world is ending and the market's going to zero.
Doom and gloom all around.
But he argues that the most important factors driving these market moves are often much more fundamental. He talks about valuation, of course, and liquidity.
Liquidity, that's all about the flow of money in this system, right?
Yeah.
How easy is it to buy and sell assets?
Exactly. And he uses the example of China back in 2011 when they tightened the money supply. Specifically, they slowed down the growth of M2, which is a measure of the money supply.
So less money sloshing around in the economy.
And what happened? Well, it wasn't just the stock market that was affected. Real estate prices in major cities went down. Even the prices of luxury goods like Lafite wine and silver started to decline.
Wow, so it had a ripple effect across different asset classes.
Right. And his point is that fundamentally, asset prices are driven by monetary forces. When there's less money available, prices tend to go down. When there's more money, prices tend to go up. It's a basic principle of supply and demand.
So understanding those bigger macroeconomic forces, like the flow of money, is really important for understanding the markets. Now, Kurgwulu also addresses this common perception that value investing, buying those seemingly cheap stocks, it doesn't really work in certain markets, like the A-share market in China.
Yeah, he tackles that head on. He says, look, the low valuations in the A-share market at the time, they were actually a lot more attractive than the incredibly high valuations they had seen a decade earlier.
So it's all relative.
Exactly. He makes a really important distinction. He says, Buying things at those super high valuations, like what they saw in the A-share market in 2001 or in the Japanese stock market back in 1990, that's not value investing.
That's just buying into the hype.
Right. True value investing, he says, is about buying things when the price is significantly below their actual worth. And paying a high price, even for a great company, well, that just doesn't make sense from a value investing perspective.
It undermines the whole point. You're paying a premium for the potential, but you're not getting that margin of safety. And he quotes a very wise man to emphasize this point.
He does. He quotes Sam Walton, the founder of Walmart, who famously said, "You can sell cheap if you buy cheap."
Simple but profound.
Right. And it really highlights that if you acquire something at a low cost, it gives you so much more flexibility in how you operate, how you price things. It gives you a cushion, a margin of safety.
So for the learner out there, this principle is really encouraging you to look beyond just the sticker price of a stock and think about its intrinsic value, especially during those times when the market might be down and everyone's feeling pessimistic. Those might be the times when the best bargains are to be found.
Absolutely. It's about having the courage to look where others aren't looking and recognizing that a low price doesn't automatically mean it's a bad investment. Sometimes it means it's a hidden gem waiting to be discovered.
All right, let's dive into our fourth and final principle for this deep dive, the importance of pricing power. Now, for the learner who's maybe just starting to explore this world of investing, can you break down what pricing power actually means and why QGlue considers it such a big deal?
So imagine a company that can raise the prices of its products or services, and people still keep buying them at roughly the same rate. That, in a nutshell, is pricing power.
They're not just at the mercy of the market. They have some control over their own destiny.
Exactly. It's a sign that they're offering something unique, or that their brand is so strong that people are willing to pay a premium. And QGlue believes that companies with strong pricing power are generally great long-term investments.
Because they're not as vulnerable to those price wars and those fluctuations in input costs.
Right. And he actually uses different eras in China to illustrate this point. He contrasts the business environment in China before 2006 with the landscape after 2006.
What was the key difference between those two periods?
Well, before 2006, a lot of industries in China were characterized by really intense price competition. There were a lot of players, not many strong brands, and everyone was trying to undercut each other on price.
A race to the bottom.
Exactly. But then, after 2006, there was a lot of consolidation in a lot of key sectors. A lot of the weaker players went out of business, and the remaining players found themselves in a much stronger position.
Less competition, more pricing power.
Right. And he gives this specific example from the air conditioning industry in China. Between 2000 and 2005, this industry was booming. The sales volume was growing really fast.
Sounds like a great time to be in the AC business.
You'd think so, right? But the problem was that all that growth didn't really translate into big profits for the companies. There was just so much price competition.
You were selling a lot of units, but not making a lot of money on each sale.
Exactly. But then, after a bunch of those smaller companies went bankrupt, the remaining players, the big ones like Gree, Midea, and Hair, they suddenly had a lot more pricing power.
And what happened to their stock prices?
They soared. Even though the overall industry growth actually slowed down after 2006, the stock prices of some of these companies increased tenfold, even more in some cases.
Wow. So even though the market was growing more slowly, the companies that had that pricing power, they were able to really thrive.
Exactly. And it shows that sometimes a change in the competitive dynamics of an industry can be more important than the overall growth rate of the industry itself.
Fascinating. So when we're looking at a company, we need to ask ourselves, do they have the ability to raise prices without losing a bunch of customers? Now, what are some of the things that give a company that kind of pricing power?
QGlue points to a few key sources. One is just having a dominant market share. If you're the 800-pound gorilla in the room, you've got more leverage, right?
Hard to compete with a big guy.
Another source is having a really strong brand. Think about companies like Apple or Nike. People are willing to pay a premium for those brands.
Brand loyalty is a powerful thing.
It is. And then you have companies that have valuable patents or proprietary technology. That gives them an edge that's hard to replicate.
That innovation is key.
Right. And sometimes a company just happens to control a scarce resource.
If you've got something that everyone needs and no one else has, you're in a good position.
Exactly. And finally, sometimes pricing power just comes from operating in an industry where there are naturally high barriers to entry, like we talked about earlier.
Less competition, more power to set your own prices. Now, Kigolu also cautions against investing in companies that lack this fundamental strength of pricing power. He talks about what he calls parasitic growth. What does he mean by that?
So imagine a company that makes a small component for a popular smartphone.
Okay, I'm picturing it.
Now, when that smartphone is selling like hotcakes, that component supplier might experience really rapid growth. But the problem is that their growth is completely dependent on the success of that smartphone.
They're riding someone else's coattails.
Exactly. And if that smartphone suddenly falls out of favor, or if the smartphone maker decides to switch suppliers, that component maker is in big trouble.
Their fate is tied to someone else's success.
And Kigolu says that's a risky bet because that company doesn't have any independent core competitiveness. They can't really control their own destiny.
So for the learner out there, the key takeaway is to look for companies that have some sort of sustainable advantage, something that gives them the ability to set their own prices and not just be a price taker in the market.
Exactly. That's a sign of a strong business, a business that's built to last.
Okay, now let's shift gears a bit and address some of the common questions that investors often have. The first one is a big one. How do we distinguish between a temporary market downturn and a more fundamental decline? Because let's face it, the market can be volatile. There are always going to be ups and downs.
Absolutely. And Kigolu's perspective is really helpful here. He says, first and foremost, you've got to focus on those business fundamentals. Look at the companies you're invested in or considering investing in and ask yourself, are their core competitive advantages still there? Is their business model still solid? Are they still generating cash flow?
So don't get distracted by the short-term noise. Look at the long-term health of the business.
Exactly. And then, he says, consider the valuation levels. Even after a downturn, are things still overpriced? Or have they come down to more reasonable levels?
Make sure you're getting a good deal. Don't overpay, even if the market is down.
Right. And finally, he says, you've got to analyze the nature of the problems that are causing the market or specific companies to decline. Are these short-term solvable issues, or are we looking at more fundamental, long-lasting problems?
Temporary setback or sign of a deeper issue.
He uses this great analogy of the SA, which means dog walking theory. He says, imagine the price of a stock is like a dog on a leash, and the intrinsic value of that company is like the owner holding the leash.
I like it. A visual metaphor.
Right. Now, in the short term, that dog, that price, might run ahead of the owner, or it might lag behind. It might get tangled up in other dogs. It might bark at squirrels. It might even do its business on the sidewalk.
Sounds like the market, full of distractions.
Exactly. But over the long term, that dog is going to follow the owner. So a temporary downturn is like the dog running off the path for a bit. But a fundamental decline is like the owner changing direction, or even worse, the leash breaking.
So we need to figure out if the dog is just being a dog or if there's something more serious going on with the owner.
Precisely. Now, the second common question investors often have is it always risky to invest in industries that are facing negative news or regulatory headwinds? Like, if a whole industry is getting bad press, should we just stay away?
Seems like common sense, right? If everyone's saying it's bad, it must be bad.
Well, Kigolu makes this really interesting point. He says that sometimes negative news or increased regulation can actually create buying opportunities.
Really? So bad news can be good news for some investors.
In some cases, yes. He says that regulatory changes, for example, can sometimes be beneficial in the long run because they force out the weaker players.
Survival of the fittest.
Exactly. And that can leave the remaining players in a stronger position, they have less competition, and they can often command higher prices.
So those who can weather the storm might come out stronger on the other side.
The key is to understand the long-term impact of these changes on the industry and on the individual companies within that industry.
So it's not just about avoiding those industries altogether. It's about understanding the nuances of the situation and figuring out which companies are best positioned to benefit from those changes.
Exactly. And the third common question investors wrestle with is, with so many different investment strategies out there, how do we know which one is right for us?
It can be overwhelming. Value investing, growth investing, momentum investing, day trading. Where do you even begin?
Well, Kigolu actually talks about his own journey in his book. He started out trying different trading techniques, but eventually he found himself drawn to a more value-oriented approach, and he emphasizes the importance of self-awareness in investing.
Know thyself.
Right. He says that the best investment strategy for you is the one that aligns with your personality, your experience, your knowledge.
So it's not about finding some one-size-fits-all approach. It's about finding what works for you.
Exactly. Now, he acknowledges that short-term trading can be appealing to some people, especially in a volatile market like the A-share market. But he points out that it's often a zero-sum game.
One person wins, another person loses.
Right. In contrast, he sees long-term value investing as a positive-sum game. If you're investing in companies that are actually creating value, growing their businesses, then everyone can potentially benefit.
It's about finding those win-win situations.
Exactly. So the key is to find an investment philosophy and methodology that you understand, that you're comfortable with, that you can stick with through thick and thin. Because let's face it, the market is going to have its ups and downs.
Always. It's a roller coaster ride.
But if you have conviction in your approach, you're more likely to stay the course and achieve your long-term goals.
All right, before we wrap things up, let's reflect on some of that core insight wisdom that we can draw from Keywolu's book. What are some of those enduring lessons that really stand out to you?
Well, one of the most powerful ideas from the book is this idea that 투시 예지, which means rationality may be delayed, but it will never be absent.
So even though the market can be irrational in the short term, in the long run, reason will prevail.
Exactly. And that's really reassuring for long-term investors because it means that if you're focusing on those fundamentals, on those intrinsic values, eventually the market will catch up. It might take time, but it will happen.
Patience is a virtue.
It is. And those 4 principles we've discussed, the industrial mindset, the contrarian approach, recognizing the value in seemingly cheap assets, and focusing on companies with pricing power, those are incredibly powerful tools for navigating the markets.
A framework for thinking.
Exactly. And remember that analogy of the dog and the owner? Well, just like that dog eventually returns to its owner, market prices, over time, they tend to gravitate towards that underlying intrinsic value.
So even though the dog might stray, the owner is ultimately in control.
Exactly. And as learners, you focus on understanding these principles, on thinking independently, and on being patient. That's what's going to set you up for success in the long run.
Wonderful. Well, thank you so much for taking this deep dive with us today. We hope this exploration of Keywolu's wisdom has given you some valuable insights to take away and apply to your own investment journey. What stood out to you as the most interesting or surprising takeaway?
Well, I think that concept of reflexivity, how the market's perception of a company can actually influence the company's reality, that's just fascinating. It really highlights the power of psychology in the markets.
It does. And for me, I think that analogy, the dog walking theory, it's such a powerful way to think about the relationship between price and value.
Yeah.
It's a reminder that in the short term, the market can be all over the place. But in the long run, those fundamentals, that intrinsic value, that's what really matters.
Exactly.
So to the learner out there, keep learning, keep exploring, and never stop questioning. And remember, investing is a marathon, not a sprint. So pace yourself, focus on the long term, and enjoy the journey.
Great advice.
Thanks again for joining us. Until next time, happy investing.
Happy investing.